Welcome back. Welcome to the next section. So here we are going to talk about market dynamics deeper. Market dynamics is the force that impacts the price and behaviors of producers and consumers, thus the creation of price signals are created. This can refer to the decisions of traders and the actions based off of general psychology in the space at any given time. This risk can either be avoided or eaten in losses. There are three major market dynamics. So we have the dynamics of supply side, the dynamics of demand side, the dynamics of securities side. So on the dynamics of supply side, we are incentivizing investors to invest more in order to increase output in an economy. In layman's terms, growth equals supply of goods and services. On the demand side, high demand in one's economy is the basic driver of economic growth. In layman's terms, wealth creation equals high demand of goods and services. Security markets, here we are talking about the fundamentals once more. This is the buzz, the speculative talk, creating sentiment, and anything that's concerning the markets chat. This can increase or decrease volatility or knowledge in the investments you choose to place on the market drives talk in Wall Street. So these are the fundamentals. We'll get into fundamentals a lot deeper later, but this is the buzz, this is the chat. This is when you wake up in the morning and the pundits are talking about general things, whether in reports or on TV channels, talking about who made the top 10 of what companies people are looking, for a positive outlook the next year, or after earning reports come out, what are the buzz, or if a company forms a merger, loses a CEO, gains a new CEO, etc. This is sort of that sort of sentiment that drives the market and makes your choices a lot more liquid. So here we'll talk about market structures. Market structure has been a topic of discussion for many, many, many years. We have economists like Adam Smith, as we mentioned, Karl Marx, who have strong conflicting viewpoints on how the markets operate in the presence of political influence. Adam Smith, in his writing on economics, stressed the importance of laissez-faire principles outlining the operation of the market in absence of dominant political mechanisms of control, while Marx discussed the work of the market, or the working of the market, in presence of a controlled economy, sometimes referred to as command economy in literature. Both types of market structure have been in historical evidence throughout the 20th century and the 21st. Market structure has been apparent throughout history due to its natural influence it has on the markets. This can be based on the different contributed factors that market up each type of market structure. So what is it? Market structure refers to the way that various industries are classified and differentiated in accordance to their degree of nature of competition for producers and services. It consists of four types: perfect competition, oligopolist markets, monopolistic markets, and monopolistic competition. Monopolies, monopolistic competition, also called competitive market, where there are a large number of firms, each having a small portion of the market share and slightly differing products. Many consumers and producers. There are a few barriers to entry and exit into the structure, difficult for new firms to enter the market and play as easy. People that choose to produce have a degree of control on where they want their prices set. We know that the demand side dictates the price as well. We can refer back to our chocolate donuts versus sprinkled donuts. Oligopoly, in which the market is by a small number of firms that together control the majority of market share. Here, we see price setters rather than price takers. The barrier of entry and exit is high. Oligopolies are typically comprised of a few large firms. Each firm is so large that the actions affect the market conditions. Non-price competition, they stick to ad campaigns, products, product differentiation, and a little competition, so consumer loyalty is key. Monopsony is where there's only one buyer in the market. So this is a lack of entry and exit barriers, makes it extremely easy to enter and play with a perfect competitive market. Monopolies commonly experience low prices from wholesalers and an advantage in paid wages. Monopsonies take many different forms and then can occur in any type of market. Pure competition or perfect competition is a theoretical market structure that features no barriers to entry, an unlimited number of producers and consumers, and a perfectly elastic demand curve. Perfect information. All producers and consumers are assumed to have perfect knowledge of price, utility, quality, and production of methods. Zero transaction cost. Buyers and sellers do not incur cost in making exchanges of goods in a perfectly competitive market. Property rights. Well-defined property rights determine what may be sold, as well as the rights are conferred on the buyer. Zero entry and exit barriers. The lack of entry and exit barriers makes it extremely easy to enter or exit a perfectly competitive market. So what's key here? When it comes to taking a look at structures, the first ideas people want to dissect is the national sort of terminology, as it does sort of correlate to the way that governance is usually structured, even though we can break these structures with characteristics that are similar to nations in their geographical regions as far as their markets are concerned. The most common avenue these structures break down into are sectors, and we will discuss that in a few. However, on a geographic front, you can see the characteristics contrived as perhaps one sole company limits the competition, or there are portions of certain industries where there are big players and small sort of hometown players. There might be one just major player, etc. Or it could be looking like the space used to be quite diverse, but it's shaping up to have one major player inside of the space. So we could use Amazon, for example, here. When it comes to online commerce and retail, for the most part, I would say from 98 to 2010, we had a very healthy e-commerce web of people being able to produce and consume goods from various different websites. Post 2010, it looks like a very much different structure where a lot of these industries usually have one big sole player that a lot of consumers like to consume from. And if you were to target or try to take customers away from these major companies to then buy from your company or a friend's company, it would be quite hard. So you'll see here that the characteristics of these structures don't necessarily mean that one nation only uses one. A lot of nations have a hybrid of various different structures. It just really depends on what section or sector of the economy that you're talking about. And we'll understand this a little deeper in a moment.